Imagine waking up one morning to find that your bank is closed. You rub your eyes, thinking it's just a glitch, maybe some technical maintenance. You grab your phone, hoping to check your balance, but the app won't load. You try the ATM down the street, and it's taped shut with a note. Out of service. Shops are open, but your debit card is useless. Gas stations demand cash only. Your rent is due, but transfers are rejected. Confusion ripples through the city like a silent wave. People glance at each other nervously, whispering questions they can't answer. At first, you assume it's temporary, a small outage that will pass in a few hours. But then you notice the mood in the streets. Lines stretch outside shuttered banks. Supermarkets are overflowing with people holding crumpled bills, their cards ignored. Panic is subtle at first, but it's there. In the tight jaws of a parent counting change, in the worried glances of elderly couples, in the muttered curses of business owners who cannot pay their employees. And then the reality hits you like a cold wave. Your money isn't where you thought it was. It's not in your account, ready to be withdrawn. It was always just numbers on a screen. And now the screen has gone dark. It sounds like the plot of a dystopian novel, a story set in a collapsing world. But this has happened before. Not in some distant, unstable country you never think about. It has happened in places that considered themselves safe, modern, and secure. And when it happens, life doesn't slow down politely. It snaps. The rules of survival and wealth shift overnight. Take Argentina, for example. The year was 2001. After years of mismanaged debt, government corruption, and repeated IMF bailouts, the economy teetered on collapse. Citizens, sensing the instability, tried to convert their pesos into dollars and move them abroad. The banks were bleeding deposits, and the government, desperate to maintain control, slammed the doors shut. Savings meant for homes, businesses, or retirement evaporated in weeks. Middle-class families who had believed themselves secure were thrown into chaos. People banged pots and pans in the streets, a cacophony of frustration and fear. Bread, milk, rent. Suddenly necessities became luxuries. Argentina was not alone. In Cyprus, 2013, the European Union intervened to manage a banking crisis. Citizens woke up to find that accounts over 100,000 euros would be seized to rescue failing banks. Businesses couldn't pay employees, retirees couldn't access pensions, and ordinary families watched decades of savings disappear overnight. Lebanon in 2019 experienced a similar crisis. After years of corruption and fiscal collapse, banks imposed severe capital controls. Withdrawals were limited to a few $100s per month, no matter how much money was in your account. Desperate depositors stormed branches with fury, and in some cases, with weapons. Even the United States, the land many consider immune to such disasters, has faced bank closures. In 1933, during the depths of the Great Depression, President Franklin Roosevelt declared a nationwide bank holiday. For 4 days, every bank in the country shut its doors. Citizens couldn't withdraw cash. Businesses couldn't pay wages. Anxiety and uncertainty reigned. The government inspected banks and selectively reopened them, slowly restoring public confidence. But think about it. One of the wealthiest nations in the world had to freeze its entire banking system just to prevent collapse. The common thread in all these crises is clear. Banks don't hold your money the way you think they do. They operate on fractional reserves. For every dollar deposited, only a fraction remains in the vault. The rest is loaned out, invested, or transformed into other financial instruments. When too many people demand cash at once, the illusion shatters. Governments, rather than admitting systemic fragility, often act to protect the banks, not the individual saver. Withdrawals are frozen, deposits devalued, and citizens are forced to absorb losses. Imagine that happening tomorrow, in your city. What would you do? Would you have cash to last a week? A month? Could you pay your mortgage if the bank itself was the problem? Could you feed your family if the numbers in your account vanished overnight? This is not paranoia. It is the uncomfortable truth. The financial system is not built to protect you. It is built to protect itself. Let's break down why. Fractional reserve banking is both a genius invention and an Achilles heel. In simple terms, banks do not sit on your deposits like coats in a check room. They take your money and lend it, multiply it, and create credit. If you deposit $1,000, the bank might keep $50 in reserve and lend out $950. That loan then becomes a deposit in another account, which can then be lent again. $1,000 transforms into $5,000, $10,000 or more in circulating credit. It fuels growth, investment, and economic activity. But it is also a house of cards. If too many people demand their original $1,000 simultaneously, the bank cannot deliver. Its ability to function relies entirely on confidence. One loss of faith, one ripple of fear, and the whole system starts to unravel. This is why, during crises, governments do not instinctively protect individuals. They protect the system. In Argentina, the corralito was imposed not out of malice, but to prevent banks from collapsing in a week. Cyprus's bail-ins were framed as tough medicine. But in reality, ordinary citizens were forced to underwrite mistakes made by politicians, bankers, and international creditors. Even in the United States during the Great Depression, Roosevelt's bank holiday was about buying time to prevent a cascade of failures. Governments and banks are inseparable. Banks need governments to enforce confidence, guarantee deposits, and backstop the system. Governments need banks to buy bonds, finance deficits, and channel credit into the economy. When stress hits, they close ranks. The person left out is always the depositor, the taxpayer, the supposed owner of the money. Deposit insurance sounds protective, but it is largely psychological. In the U.S., the FDIC guarantees accounts up to $250,000. But ask yourself, if every depositor rushed to claim that insurance, would the money truly exist? No. The fund is only a fraction of total deposits. Its real power lies in confidence, not cash. When banks shut down, commerce grinds to a halt. Salaries are delayed. Supply chains freeze. Factories can't import materials. Supermarkets cannot pay suppliers, and shelves empty. Weddings are postponed, surgeries delayed, children pulled from schools. What starts as a technical or political decision in a boardroom cascades into a full-blown social crisis. Panic spreads like wildfire because wealth in this system is fluid, and it can vanish overnight. Even today, in an era dominated by smartphones, digital wallets, and fintech apps, the risk persists and has arguably deepened. A cashless society is more convenient, but it makes us more dependent on centralized systems. If a server fails, if a card reader stops functioning, if your account is frozen, wealth instantly becomes intangible. Money as digits on a screen is only valuable as long as access is guaranteed. Consider the ripple effects. Businesses cannot pay workers, so layoffs multiply. Supermarkets cannot restock, so shelves empty. Investors panic, selling assets at fire sale prices. Retirement accounts, pensions, and savings take hits. Governments scramble to restore confidence. But every day the lines grow. Every day the patience wears thinner. The seemingly abstract world of banking suddenly becomes painfully real, affecting every meal, every commute, every bill. History shows that stability is fragile. In Greece, during the 2015 crisis, citizens queued at ATMs in sweltering heat, waiting hours to withdraw a mere 60 euros a day. In Lebanon, ordinary people realized that their leaders had gambled away their future. In Cyprus, middle-class savers saw decades of careful work vaporize to save institutions deemed too big to fail. And in the U.S., the Great Depression created lifelong habits of saving and mistrust in the financial system. The lesson is clear. Your money is only yours until the system says otherwise. A balance in a banking app feels secure until it isn't. And confidence the invisible glue holding the system together, can crack in an instant. One rumor, one crisis, one policy change can ignite panic. Once that panic spreads, even healthy banks can collapse. Confidence is the lifeblood of finance, and history proves it is shockingly fragile. So what can you do? Reactionary fear, like rushing to withdraw all your money, is rarely effective and often dangerous. The real solution is resilience. Diversify your assets. Keep wealth in more than one form, more than one institution, even more than one country. Real wealth is not just what you earn, but what you can access in a crisis. Cash, gold, real estate, alternative stores of value. These are lifelines. They are not old-fashioned ideas. They are survival tools. And beyond personal preparation, awareness matters. Governments create laws that appear to protect citizens, but often safeguard the system first. Deposit insurance, emergency powers, and capital controls are ways to manage panic, not prevent collapse. Understanding this reality allows you to take strategic steps, protect yourself, and even advocate for transparency and accountability. Complacency is the most dangerous risk. Banks do not need to physically fail to create a crisis. They only need confidence to falter. And when the system falters, the consequences are immediate and widespread. Banks are not neutral service providers. They are power structures entwined with governments, corporations, and global markets. You are not just a client, you are a participant in a system that works until it doesn't. History does not repeat exactly, but it echoes loudly. From Argentina to Cyprus, Lebanon to Greece, from the Great Depression in the United States to modern-day crises, the same lesson emerges. Access is not ownership. Money held in a system you cannot control is always vulnerable. The illusion of safety can shatter overnight. This is why understanding history matters. When Argentina closed its banks in 2001, the outrage was about more than lost money. It was about betrayal. Citizens realized that the system they trusted could turn against them. In Cyprus, decades of careful savings were vaporized to rescue institutions that were deemed indispensable. In Lebanon, a generation witnessed their country's financial foundation crumble. And in America, the memory of the Great Depression shaped the financial habits of an entire generation. The uncomfortable truth is this: the financial system exists to protect itself first, and the individual depositor second. When stress hits, institutions and governments make choices to survive, often at your expense. Money, as you know it, can vanish in an instant. Now imagine waking up tomorrow. Your bank's website is offline, your debit card declined, your paycheck delayed. Weeks pass. How do you feed your family? How do you pay rent? How do you function in a society where digital numbers have no tangible value? These are not hypothetical scenarios. They are real events that have unfolded around the globe, in countries you may not expect. The lesson is both sobering and empowering. Wealth is not measured by numbers on a screen. It is measured by access, mobility, and resilience. Diversify. Protect yourself. Learn from history. Understand the fragility of the system. Confidence can be fleeting, but preparation is enduring. Because one day, the question will not be, what if banks shut down tomorrow? The question will be, what do I do now that they already have? History has the answers, and it is waiting for those willing to look. If this video opened your eyes or gave you a new perspective, don't let the message stop here. Hit like to show your support, share it so others can learn too, and subscribe to Finance Compass so you never miss the insights that can help protect your wealth and future.